Welcome to McQuilling TV. I'm Claire Schmidt, and joining us again today is Connor Stone, Marine Transport Advisor with McQuilling Services. Glad to have you back on, Connor.
Thanks, I'm happy to be back, Claire.
So last time you joined us, you were speaking mostly about the dirty market. Could you take today and talk about the clean market?
Yes, so discussing clean tanker demand, we're seeing a different picture than the dirty side. We expect an acceleration this year, growing by about 4% year on year versus last year, which was about less than 1%. The LR tankers will really benefit from the Middle East this year. The clean product balance there, which is your gas oil, gasoline, naphtha, jet fuel, that's going to grow by about 626,000 barrels year on year. So you're going to see a lot more flows to both the east and the west, benefiting LR2 tankers mostly, particularly to the west. The LR2 trade from Middle East to Northern Europe is likely to grow by about 9% this year, and that's because you see a flat to negative development in the clean product balance in Northern Europe, so they're going to require more imports. As far as volumes to the east, we do expect them to grow, especially for demand for LR2s. LR1s aren't likely to serve this demand this year. We see more of a preference for them to send product into Southeast Asia, and that's mainly because you have a declining clean product balance in India. So the Middle East will likely step in to serve Southeast Asia, which is more of an LR1 trade. So we do see that demand growing this year. As far as MR2s, for the sector as a whole, the average mileage traveled did fall last year. You had a lot more volumes from the U.S. Gulf being sent to the Caribbean, less going to Brazil. Brazil's had some production issues there. There were some fuel strikes, and there was also more use of ethanol versus gasoline. So you had less imports going in there, but this will reverse this year. For the U.S. Gulf Brazilian trade, specifically to the East Coast South America region, we expect that to grow by about 7.3% this year, and ton-mile demand into the Caribbean will also grow by about 2% this year. So all in all, it's a growth picture for the clean side of the market, which is very good.
So a better demand picture then for this year?
Yes, relative to 2018, which was really just a year of very marginal growth.
Great. Well, can you tell us more about the supply side and how that's going to affect freight rates?
Yes, so looking at the supply side, the clean market is expecting to improve a lot quicker than the dirty market. We're seeing growth in deletions, and then we're seeing less deliveries over time. So we expect about 35 product and IMO 3 chemical tankers to join the fleet this year. This compares to about 71 last year. And when you look at the net fleet growth profile, that's really telling of how this market is improving. In 2017, you had about 1.5% growth. Last year, you had 0%, so flat. This year, we're expecting it to actually contract slightly, about 0.3%. So over time, this will improve, and we're a little more bullish on the clean market as a result. And adding support to this is also the chemical market. You have to consider these vessels because they can take clean products. Looking at IMO 1 and 2 ships, we're seeing net fleet growth of about 6.7% this year, and this is less than half of the levels we saw in 2016. So overall, less clean tonnage in the market gives us a more bullish outlook for freight rates.
So you expect freight to gain?
Yes, we expect more upward support on the front end of the curve versus the back end. Years 2022, 2023 are likely to flatten out. For the benchmark TC1 LR2 trade, we see freight rates averaging about World Scale 98 this year. That's a $16,000 per day TCE. And then the freight rate should increase further to about World Scale 102 next year. But because of the uptick in bunker prices, you'll see TCEs around $7,600 per day. For the MR2 sector as a whole, we expect TCEs to average around $14,600 per day this year. Will drop down to about $12,500 per day in year 2020, and then by 2023, we should average around $16,300 per day. And in terms of freight rates for the MR2s, we expect a gain across all the trades that we're tracking this year, excluding TC3, which is likely to face a little bit of pressure due to poorer refining fundamentals in the Caribbean. But ultimately, it's a positive story for clean tanker freight rates, especially on the front end of our curve, whereas the back end will kind of flatten out.
Okay, great. Thanks so much for coming on, Connor, and sharing your views on the clean market today.
Of course, no problem.
I'm Claire Schmidt, and that wraps up another edition of McQuilling TV. Thanks for tuning in.